From the Aishin Broadcast Studio, it's the Executive Spotlight.
Welcome to the AutoSuccess Executive Spotlight. I'm your host, Brian Ankney. Today, our guest is Joe Mowery from Stevens. Welcome, Joe.
Thanks, Brian. It's great to be here.
Yeah, and when we were talking before, I didn't realize how much we had in common. We both work for companies that are third-generation family-owned businesses.
Pretty cool, and then I mean, it's really an honor to work for a business that has been around that long, and is continued to be operated by the family.
Yeah, yep, yeah. I mean, we're 105, and what, you're 92?
Yeah, just over 90 years, approaching our 100th anniversary as well.
Nice. Well, let's start with some M&A. Tell me about 2025 and what you see coming for 2026.
Yeah, 2025, Brian, was what we and others have often labeled as the year of normalization. Of course, COVID was very disruptive, and frankly, even getting into 23 and 24 from an M&A standpoint was still not normal. Valuations were not normal. Seller interest was rising and then falling. Buyer interest was rising and then falling. It was very disruptive. But 2025 became a much more normal year. I would say from a geography standpoint, we definitely saw what a lot of people are aware of, a lot of strength in states like Texas, Florida, the Carolinas. But I believe really across the country, it was still very stable. It was a good, solid market. Of course, we had the honor of working with the Herb Chambers companies up in the New England area. That was 33 stores. That was a really big deal. But what we saw in our practice and what we're continuing to see in 2026 was a good, solid amount of M&A activity.
Let's talk about brands, because dealers tend to be really interested in brand when they're buying, and you guys kind of have a unique perspective on that. Can you tell me a little bit about that?
Yeah, Brian, it is interesting. When we talk to a lot of our buy-side relationships, they'll be telling us about what geographies they want to be in, what brands they want to have, what size stores they want to have, different things like that they're looking to check those boxes with, so to speak. But we often have a lot of dealers that will tell us, do not show us these certain brands. And I'm not going to mention brands by name in this conversation, but a lot of people out there know the 2 or 3 brands that often dealers just don't want to see nowadays. And we take a little bit of a different approach to that. I mean, Stevens is a full service financial services firm. We tend to think of M&A as an investment, not just an acquisition. And so when you think about investments, let's think about the stock market. There's an old saying, buy low, sell high, right? So we kind of take that approach to M&A as well. It's a little bit of a contrarian approach, but what I'm really getting at there is we think some of the brands that may be out of favor, but they're trading at very low multiples today, could be interesting brands to go ahead and acquire as long as it's a store that is capable of being operated profitably and it's in a good location and you're able to get that price at a valuation that makes a lot of sense. We think that could offer a really nice return on investment over time, compared to paying some of the higher multiples that are out there for some of the more sought after brands.
Yep. Well, I mean, if you look at it, the brands that are sought after today might not be the same brands that are sought after tomorrow. And I mean, not to name any brands, but there are definitely some brands that 10 years ago were not sought after that are very sought after now.
You are exactly right, and that's what we've had. We've had some very large dealers, dealers that have been around for 40 years, and when we talk to them about this topic, they remind us of a couple of things. One is brands come and go. The cycles come and go. Brands that are down now may be back up in 5 years. Brands that are up now may make some strategic decisions that are poor, and they might be down, 5 or 10 years from now. So if you play this game long enough, you will see that. And so having that diversity among brands is a good thing. And then the other thing I would say, that we hear from some of those dealers is there's never been a better time to buy some of these brands that are down.
Yeah.
Again, because the valuations are low, and frankly, the upside's probably a lot more than the downside.
A couple years ago, I went to a grand opening of a new dealership for Columbus Dealer Group, and the dealer was like speaking to the group, and he said, "When I bought this franchise, I paid less for it than I paid for the pavement at the new dealership parking lot." I mean, like that, and so what? And now the brand is a very strong brand. I mean, what an investment, right?
Yeah, exactly. We've seen that exact scenario play out with some of our clients as well, where they may have actually started what is now a very large, robust group of dealerships with a brand that's not even in existence anymore.
Yeah,
But it was their gateway to what they've built into a great overall group of dealerships today.
So tell me about 2026. What do you see coming?
What we're seeing is there are a lot of buyers out there. I mean, dealers know their industry better than anybody. They're still excited about the industry. It's a great industry for further investment, and so there are a lot of buyers out there that want to continue to grow their businesses. So there's a lot of interest. There's a lot of money, chasing deals, and so I think that's a great thing for the future of M&A in the dealership space for the next year and the foreseeable future. From a seller standpoint, I think the normalization that we were talking about earlier kind of comes back to the fact that sellers are now becoming active for the same reasons they often have been in the past, right? It's succession planning, it's an interest in retiring, or in some cases it may be that they want to sell some stores that no longer fit their strategy. So they just want to do some divestitures or carve-outs, if you will, but not necessarily sell their business.
Mm-hmm.
So we look forward to a solid 26 and beyond.
Well, let's talk about the money that it takes to buy dealerships. Private credit has been in the news a lot lately. I mean, what, $3 trillion of it? Talk to me about that. What is it?
Yeah, so a lot of dealers are very unfamiliar with that term for
Mm-hmm.
sure, because most of the acquisition capital in dealership space comes from just simply dealers using cash on hand and available credit that they get from existing commercial banking relationships, traditional banking relationships. They're often pretty conservative about the way they set up their balance sheets, and so that's where most of the credit comes from, right? Especially in dealership world. Private credit is coming from non-traditional bank lenders. It's coming from institutional investors that, frankly, many people in your audience may not even know the name of these firms. You can't get a checking account
Yeah.
at many of these private credit lenders, or most, if not all, of these private credit lenders. These are institutional investors that are simply looking to invest in businesses through debt, through a debt security as opposed to an equity security.
So what are the advantages of private credit?
Yeah, private credit can definitely be good as a part of a competitive process.
Mm-hmm.
When you're looking for additional capital for acquisitions, or maybe just to consolidate your balance sheet. The advantages basically come from the ability to maybe get a little more debt, maybe get a little more leverage, another half a turn or maybe even another full turn of EBITDA in terms of the amount of credit capacity compared to commercial banks.
Mm-hmm.
The other thing has to do with just flexibility of the terms. Maybe the amortization schedule, maybe some of the covenants that you have to deal with and monitor on a regular basis. Those can also be a little bit more advantageous. The flip side is there's a cost to those advantages, right? And that cost comes in terms of paying a little bit more interest than you might expect to see from commercial lenders. But having said that, we've seen those spreads tighten.
Mm-hmm.
The difference between the commercial lending universe and the private credit universe, we've definitely seen those spreads tighten. And I would say, especially for high quality dealers that have a proven acquisition strategy, where a private credit lender really views that situation as the opportunity to partner with somebody for the long term, a dealer that's going to be a great partner, a great way for them to put more capital to work for a long period of time. We've seen those interest rate spreads tighten up quite a bit, so they can really get competitive on price as well.
What are the challenges that come with that?
Yeah, listen, the primary difference is the cost of capital. You know, you're talking about interest spreads, rate spreads that have tightened. At the end of 2025, we saw a tightening of rate spreads. Even commercial lenders, are in a situation now. Traditional commercial lenders are in a situation now where I would say the end of 25 and the start of 26 started out as a borrower's market, if you will, and so those rate spreads are a little bit tighter. Private credit has also gotten more competitive. They've got a lot of money to put to work, and so they've gotten more competitive. But because of that flexibility that we were talking about earlier, the ability to get more leverage from them, the ability to get a little bit more flexibility on the covenants and that kind of thing, usually that spread is going to be a little bit more with a private credit lender.
A lot of times you see personal guarantees, when dealers access, capital. With private credit, what does that look like?
Yeah, you're exactly right, Brian. And certainly when you're starting out as a dealer, or when you only own a few stores, that's very common to have personal guarantees. But as dealers acquire more and more stores, let's say they get up to 10 or 15 stores, and they still have 3 or 4 different credit facilities that they're dealing with, which can be complicated, and they may have personal guarantees on all those stores. That can be an issue. That can be a bit overwhelming to a dealer. And so, great question about private credit. I mean, I can't tell you that private credit will always allow you to drop the personal guarantee. But what I would say is that, we were talking about a competitive process. If you have a competitive process to consolidate that debt, maybe it's in connection with your next acquisition and you need some additional capacity to fund that acquisition or whatever. If you have a competitive process, whether you're talking about traditional banks or private credit lenders, there's a good chance that as you grow with that scale and through a competitive process, you can get rid of those personal guarantees.
Well, dealers love making deals. Talk to me a little bit about, have a competitive, being competitive and getting lenders to compete against each other. I mean, is that something dealers are able to do?
Absolutely. A lot of dealers, and there's nothing wrong with this. A lot of dealers are borrowing money from the banker that they play golf with, or that they go fishing with, or whatever, right?
Yeah.
And that's great. There's nothing like doing business with friends. But when you get up into a situation where you got some scale, you got 10 stores, 15, 20 stores or more, you're getting into a situation where lenders should want to lend you money. You shouldn't be asking for their money.
Yeah.
They should want to be your partner. And so, as a full service investment bank, we have a debt capital markets team that's dedicated to doing nothing but dealing with lenders, commercial lenders and private credit lenders every day. That's what they do for a living, all day long. And so, they're able to take a situation and go into those credit markets and present the client in a way that makes that lender want to be the partner, and it makes them appreciate the fact that you got a great business and that you want to grow that business, and you're going to need that partner for a long period of time. You're going to continue to buy more stores or renovate stores or whatever the case may be. And so generating that competitive process to get them to put their best foot forward, we think that's very important. And hopefully it can still be your friend that you go golfing with, but you're able to get that person to put his best foot forward as well.
Let's move on to family offices. Tell
Sure.
me, like, what is a family office? What does it look like?
Yeah, well, family offices are becoming more well known in the dealership space for sure. We have a dedicated team on that front as well that that covers the private capital space, broadly speaking.
Mm-hmm.
When many people think about that, they think about traditional private equity, but we not only cover that, we also cover around 400 family offices at Stephens. And so, to directly answer your question, a family office is a large investor, generally a pretty large investor, that's investing money of one wealthy family, or perhaps from multiple wealthy families. You will often see that where a lot of family offices, or maybe a select few family offices in any given one deal, might pool their capital together to make an investment in a partnership.
So what are the advantages of working with a family office as opposed to some of the other things we've talked about?
Yeah, the two big things there, Brian, the first advantage is that it's long-term capital, as opposed to a lot of financial sponsors that are looking to exit an investment in 3, 5, 7 years. Family offices, they're looking for a good investment that they can hold for 20 years or 30 years. I mean, we hear family offices often tell us, we want to own it forever. You know, if it's a good investment, if we're backing a good management team, we want to own this investment forever. You know, we don't want to have to find another place to put our capital to work. So that's a great thing for anybody, really, right? But
Yeah.
especially a dealer, to know that you're not going to have to worry about finding another partner X number of years from now. So that's the first big advantage. The second big advantage is the fact that family offices tend to be a little bit more passive in their approach. In many cases, they don't have big organizations. In some cases, they will have, you know, some operational expertise kind of behind the scenes and a little bit of a staff built out. But I would say for the most part, they're not looking to make an investment in a dealership whereby they're going to try to micromanage your business and tell you what your operating hours ought to be, or whether you ought to put the cars out front or the trucks out front. You know, that's not the kind of thing that they want to do. They want to back a strong management team, and they want to be there when you need capital, and they want to be there when you kind of need board level advice. That could be in connection with mergers and acquisitions and sourcing those and executing on those. But generally they're going to be a little bit more passive. And so when we think about both of those things, the long-term approach and the more passive approach, that's also something that OEMs like. They also don't want to have to approve of another owner just a few years down the road. And they also want to make sure that they know that the dealer that they've been dealing with all these years is still going to be running that store, and that's going to be the person that they're going to be dealing with. And so we've seen the OEMs approve of a number of family office investments in the space. We were fortunate to work with the Hudson Group and the Morgan Group on their separate investments that they got from Redwood Capital. There have been several other family office type investments into the space, and so it's at least clear for now that the OEMs seem to like that approach as well.
You know, I mean, it sounds like for a dealer that's looking to grow their portfolio of dealerships, that the family office would be something they should probably take a look at. I mean, can you explain a little bit more about how that might work?
From an investment standpoint, a family office can come in as a minority investor. I would say there are probably more of them that prefer to be a majority, but they can come in as a minority or a majority investor. You're generally going to see the deal size come from family offices that are interested in putting money to work of, let's say, $20 million equity check up to hundreds of millions of dollars.
Oh, wow.
I mean, it would surprise you to know how many family offices are out there that can easily cut $100 million or even a $500 million or more equity check. So when you're thinking about, or when a dealer is thinking about a really transformational opportunity where maybe there's no way that the debt capacity is there to do that deal, and you need a partner to do that deal, again, a family office can be a great solution there. It might require a lot of money, but they can be a great partner for that situation.
Wow. I mean, it sounds like they would be a great partner, because you've got somebody that, a partner that isn't going to tell you, like you said, put the trucks or the cars out front,
Yeah.
but a partner who can help you on the financial side, but then also on the board level side. I mean, that sounds like a great partner if you're trying to grow your portfolio.
100%. I mean, I think what we've seen when we talk to dealers that have done this
Mm-hmm.
and that have 3, 5, 7 years of experience now with a family office, we've seen a lot of happy customers in that space. And we don't just follow the auto space. We also follow the agriculture dealer space, the construction equipment space, the truck dealer space. And there's also a lot of family office interest there. And those situations that we've seen, those case studies that we've seen, they also make for good precedent that family offices can be really good partners for dealers.
Well, Joe, thank you for coming in today.
Thank you so much. It's been a pleasure being with you and talking about these topics.
And thank you for taking the time to join us for this AutoSuccess Executive Spotlight. I'm your host, Brian Ankney. Today, our guest has been Joe Mowery from Stevens. We hope to see you again on a future episode. This one's Over the Curb and Burning Gas.